Investors poured over $1 trillion into ETFs in 2024, with single stock ETFs notching the highest annual returns and crypto ETFs seeing the largest overall inflows. So what's in store for ETFs in the brand new year? For more, I want to bring in Vince Lorusso, who is the Clough Capital President and CEO, for this week's ETF report brought to you by Invesco QQQ. Great to have you here with us, Vince. First and foremost, as we think about some of the record inflows that we saw into ETFs in 2024, do you believe that that is expected to be the same type of spend or at least inflow propensity for 2025? And if not, where at least could we still see some signs of strength?
Yeah, hi, Brad. Thanks for having me. Look, I think the flows into ETFs are going to continue for several years at least into the future. And the reasons for that are not necessarily the investment strategies or the exposures that investors are seeking. It is the regulatory change that began in 2019 when the SEC came out with the ETF Rule 6C11. It began to open the door for active managers to take advantage of the ETF structure. And investors have taken notice, right? So ETFs for almost 3 decades have been really the domain of passive strategies. But when you open that window for active managers to move into that structure, the improvements, the chassis is just better. The tax efficiency, liquidity, and transparency of ETFs are ushering in a new level of interest and enthusiasm in ETFs, and the asset managers are responding, right? We're launching new ETFs, converting funds into ETFs, and Clough Capital was really at the forefront of that with a couple of ETFs that we listed on the New York Stock Exchange back in 2020 through ChangeBridge, now part of Clough Capital. So we've passed our 4-year milestone, and we see the growth happening, and we think we're really just in the early innings of that. Active strategies are still less than 10% share of all ETFs, and that number is going to go higher.
So we had a portfolio manager on earlier on in the show saying that some of the biggest opportunities that they were tracking existing in sectors such as financials, consumer staples, and producer durables. Does that necessarily transfer through, at least in terms of some of the biggest opportunities, into sectors that ETFs would see the most benefits from as well?
I think you could see that, Brad. So what investors are going to do is, at a broad level, look for a structure that best suits their needs. And sometimes those needs are the transparency, liquidity, tax efficiency, right? So that's the broad trend into ETFs. Within that, where are investors finding opportunity, or where do they see the most potential for growth? And they're gonna look for geographies, sectors, risk factors, whether that be small versus large or value growth. So those investor preferences or attributes are going to be garnering assets. It could be digital currencies, single stock exposure. They could be seeking yield. But I think it's just really important to zoom out and say, look, the broad trend into ETFs is more about the structural benefits. And then within that, where are investors gravitating? And we, as active managers at Clough Capital, we give ourselves a broad mandate. So we are able to look across geographies and sectors, and we're somewhat agnostic about a lot of the risk factors. We just want to find the specific companies that give our investors the best risk-adjusted return opportunities. We build a portfolio from those opportunities through fundamental research and analysis. But the broad observation, I think you're spot on. People are going to move into the sectors, risk factors, geographies that they want, and they're going to largely look to do that in the ETF structure, potentially first.
Which sectors do you believe those are?
Yeah, so right now we're probably, it's that time of year here as we kick off 2025 to feel a little bit contrarian, to try to look for areas that maybe have missed out on the broad lift in equities. We continue to be very bullish on equities, despite kind of 2 years of significant outperformance by the S&P 500 and kind of broad participation across a lot of sectors. We would probably begin to skew into some of the more value, parts of the equity landscape. So things like industrials and energy and consumer staples. We think the setup here is pretty good. If you continue to get a lift in equity exposure and a movement from maybe short duration money market type investments into the equity market, we think that trend will continue. So we're trying to find some of the laggers, and I think the opportunities in industrial, energy, and consumer staple are really interesting right here, especially on a risk-adjusted basis, because the valuations are much more compelling.
That considered, as you're thinking about industrials, and especially as we're kind of tracking across some of the sectors that were outperformers last year and where there could continue to be outperformance this year versus those that were underperformers, are you banking on a big bounce back on a sector basis this year?
Probably not. I think that goes back to our core investment process at Clough Capital, right? So we're more company specific. And by the way, we list all of our holdings on cloughetfs.com, including a prospectus. So you can see that, we'll have less than 40 longs in the ETFs at this moment in time, which is really an indication that we're not trying to make the broad call on a sector or a risk factor or even a geography. We're saying, look, within that, do we see opportunities? And the industrial opportunities to us look compelling, especially when you can get the tailwind of some of the onshoring trends that we think are very real, some of the build out in technology infrastructure, for example, and some of the data center needs. So, the question for us becomes, all right, we see this broad opportunity for equities. We think there's going to be a lift in equities as rates come down, as the economy still exhibits growth, as the labor market looks pretty strong, as the Fed becomes more accommodating, right? A lot of reasons to be in equities. Okay, within that, where do we see tailwinds? We think the infrastructure, onshoring, industrial, energy build out is very real. We need more energy supply to meet the demands associated with the build out of AI and data center needs. So then within that, we go another layer, right? What are the specific companies we like? An example like a Sterling Infrastructure, for example, which is a long position in both CBLS and CBSE, the two strategies that I manage. Well, that's a specific name where we've done the research, we trust the management team, we think they're exhibiting strong growth. They have this tailwind of industrial and infrastructure build out. And as an equity play, they generate free cash flow and they're exhibiting strong growth. So, that's kind of the process that we go through, Brad, to build a portfolio. I think broadly, if you see some sectors start to play a little bit of a catch-up trade, I think they could benefit from that as well. But look, technology is still the center of the investment universe. I mean, it's probably approaching or more than 40% of the S&P 500. We think that could continue to do well. But if we're trying to generate alpha for our investors and find individual opportunities that are, frankly, have an asymmetric risk-reward profile, they are pulling us more into some of those other sectors that I mentioned, industrials, energy, and consumer staples.
Vince, thanks so much for taking the time here with us today. Really appreciate it.
My pleasure.